There is a financial system running in the background of your life, a silent operating system that the wealthy understand intimately and use every single day. You were never taught it, you were never meant to use it, and most people have been actively steered away from ever seeing it. But once you see it, once you truly understand how it works, you can't unsee it. In our last video, we exposed how owners and workers are playing by two fundamentally different sets of rules when it comes to money and taxes. And here's the part that nobody tells you. The tax code was not designed for workers. It was designed to reward owners. And the minute that you cross that line, even with just one rental, you're suddenly playing a completely different game. And today, I'm gonna teach you the owner's playbook. I'm here to show you the fundamental, almost invisible system that the wealthy use to not just get rich, but to stay rich forever, and to compound that wealth beyond what most people could ever imagine possible. And when you combine this owner's playbook with one twist in the tax code that we're going to talk about in today's video, you unlock what I call the Zero-Tax Snowball, a system that lets your wealth compound faster than the IRS can tax it. This video is part 2 of my series that's meant to expose this entire system. So you're going to want to hit the subscribe button and the notification bell to stay tuned. Let's cut right to the chase. Wealthy people get wealthy by not selling the assets that make them money. They get wealth by leveraging those assets to make them more money with new assets. This is the owner's mindset, and it's the core of a system that never truly resets. And here's what most people don't realize. Wealthy families do this through businesses, through stocks, and through real estate. But for normal people, people without millions in stock or equity, there's really only one accessible way to do this, and that's real estate. Because real estate gives you cash flow, leverage, appreciation, and tax advantages that you just don't get from a paycheck. Let me show you the simplest version of that, and where the crucial mindset shift actually happens. Imagine you buy a property. Let's say it's a nice single-family home. Every month, this property produces a small amount of cash flow, maybe $300 a month initially. But more importantly, it offers something called depreciation. Even if it's brand new, the IRS allows you to deduct a portion of its value each year as if it's wearing out. And of course, over time, that property rises in value. This is called appreciation. Now, here's where the everyday 9-to-5 worker mindset takes over. After a few years, maybe that house that you bought for $400,000 has appreciated and is now worth $500,000. Most people think, wow, my property has gone up $100,000. I should sell now and cash in on that profit. And they do. They sell the house. They get their $100,000 profit, but then Uncle Sam comes knocking. Because that $100,000 profit, that's called a capital gain. And depending on your income bracket, the government is gonna take 15 or 20%. So that $100,000 profit quickly becomes $80,000 or $85,000. You pay your taxes, feel the sting, and now have a pile of cash, but you've lost your asset. Your wealth journey has hit a reset button, and that right there is the trap. You're playing a game where every time you score, the referee takes a cut and then sends you right back to the starting line. Wealthy people understand that selling equals taxation. So here's how a truly wealthy person would approach that same $400,000 house now that it's worth $500,000. They wouldn't sell it. Instead, they would borrow against it. And the key here is understanding a fundamental truth. Borrowed money is not income. And because it isn't income, it's not taxed because it's debt. So let's say when the wealthy person in our example here bought that $400,000 house, they went to the bank and they got a $320,000 mortgage, assuming a 20% $80,000 down payment. And over the years, that wealthy person's tenants helped pay down the mortgage significantly, perhaps to $280,000. And the same house has appreciated to $500,000. Most lenders will allow that wealthy person to borrow up to 75% of that new appreciated value through what's called a cash out refinance. 75% of $500,000 is $375,000. That means that they can pull out $95,000 in tax-free cash. That is money that flows into that wealthy person's bank account completely untouched by the IRS. And yes, before you ask, this strategy uses debt. But wealthy people don't fear debt. They fear taxable events. Debt is simply the bridge that lets your assets keep working while your taxes stay low. As long as the assets pay for the debt, it's a tool, not a threat. They take that borrowed money, that debt, and they use it to buy another property. That second property also produces cash flow. It also offers depreciation, and it appreciates over time. Then when that property has appreciated enough and gained sufficient equity, they borrow against that house. This right here is the owner's mindset. It is a relentless compounding cycle. Buy, grow, borrow, buy again, and they repeat this process, building a larger and larger portfolio of assets that cash flow, provide deductions, and appreciate over time. And most importantly, they do this without ever triggering a taxable event by selling. And this is what's called the borrow until you die strategy. This is exactly why billionaire founders like Mark Zuckerberg and Elon Musk famously take a $1 salary. They don't need income because they have billions of dollars of company stock. They borrow against that stock, using it as cash-free tax to fund their lives and their ventures rather than selling and incurring massive tax bills, because they play by the owner's playbook. And here's the crazy part. When they die, their heirs inherit those assets, stocks and real estate, with a full step up in basis. Meaning if those heirs decide to sell, they own nothing on decades of gain. And the snowball keeps rolling, transferring wealth across generations, avoiding the tax reset button at every turn. And the crazy thing is, it's not illegal. It's worse. It's allowed. It's a system designed to keep wealth within families, compounding generation after generation, completely legally, completely ethically. And this is the game being played in the background. For generations, the borrow until you die system felt exclusive. It seemed only accessible to individuals that already had large sums of capital or company stock. And the everyday worker was left on the outside, stuck in a different paradigm. Every single year, earn, get taxed, spend what's left. It's an endless treadmill designed to keep you generating income, only to have a significant portion siphoned off by Uncle Sam, preventing you from ever truly accumulating and leveraging significant capital. Remember, for many Americans, you're working 3 to 4 months a year just to cover your tax bill. That's how much of your wealth is kept from you. And the difference between these two paths isn't intelligence. It's not how hard you work. It's access. Access to the information, access to the strategies. And here's the critical point. While many forms of ownership can get you into this game, real estate is the one true vehicle that anyone can use to sneak into this wealth building club. It doesn't require billions in stock options. It requires understanding the playbook. And for a long time, this divide between the wealthy and the working class just felt insurmountable. The wealthy played by these rules, compounding their fortunes, while the working class paid their tax bills year after year, unknowingly funding a system that they couldn't even see. Until now. See, for decades, this was a game that was reserved for people that already had millions. But something changed. Something that suddenly gave W-2 earners a way to generate the capital that they need to start their own borrow until you die strategy. But how? The answer lies in a powerful twist in the tax code. One that was quietly, almost miraculously brought back this year in a massive, messy, and controversial piece of legislation.
The so-called One Big Beautiful Bill.
Big Beautiful Bill.
The Big Beautiful Bill.
But what the news missed amongst all of the political noise was that this didn't just bring back a tax break. It delivered the ultimate supercharger for building your initial asset base. And it unlocked a new way for millions of Americans to keep more of what they earned. Here's how. In episode 1, we talked about short-term rentals, aka Airbnbs. We showed how if you own one, and more importantly, if you materially participate in managing it, essentially treating it like an active business, the IRS doesn't treat it like a typical long-term rental. And this little distinction from long-term rental to short-term rental changes everything. Because when you're actively managing your short-term rental, your losses from that property, those paper losses created by things like bonus depreciation, can offset your day job income, aka your W-2 income. Hey, really fast, if this all sounds interesting to you and you're interested in knowing how much a short-term rental can help you save in taxes on your W-2 income, I have put together a free calculator for you to help figure that out. I'll leave it linked in the description down below for you. We made a whole loom to walk you through it. It's super easy. All right, back to the video. And by the way, bonus depreciation is not a minor tax break. This is the ability to take years, even decades of tax write-offs, potentially hundreds of thousands of dollars, and apply them in year one. Just think about that. Instead of slowly depreciating your short-term rental over 39 years, the government is essentially saying, go ahead, take a massive chunk of your W-2 income, make it disappear on paper, and pay almost nothing in taxes this year. This is what's called offsetting your taxes, okay? They're not vanishing, they're not going away forever. You're kicking the can down the road. So you can kind of conceptualize this as the government giving you a tax-free loan. You use it to acquire more assets, to fuel your wealth snowball. You use it to start playing the borrow until you die game. And that's why I think in the world of real estate, owning and managing a short-term rental is the greatest tax strategy of all time because it allows you to immediately offset and eliminate your biggest outgoing expense, your taxes, and redirect that capital into your own financial machine. Let me show you how this all begins to unlock the borrow until you die strategy. This isn't just about reducing your taxes. It's about generating the initial capital to build your perpetual wealth machine. Let's take our typical W-2 worker. Their W-2 salary is $100,000. And the typical taxes that they would owe are anywhere between $18,000 and $22,000 annually. Now you acquire a $500,000 short-term rental property, and you actively manage it for at least 100 hours and more than anyone else in your organization. You get a cost segregation study down, which if you need one, by the way, you can get over at strcostseg.com, maximizing what qualifies for bonus depreciation. This accelerates depreciation and creates a massive paper loss in year one. And in a very rough rule of thumb, 25% of the property's value, and a realistic number in this example is $125,000. This $125,000, now thanks to bonus depreciation, can offset your W-2 income. So your taxable income of $100,000, well, it drops to zero. And that $18,000 to $22,000 tax bill that you were bracing for, offset. It's gone. It's eliminated. You kick the can down the road. And even better, you now even have an extra $25,000 loss left over that you can carry forward into the next year, continuing to reduce your tax burden. And now instead of paying Uncle Sam $18,000 to $22,000 and saying goodbye to that money, you get to retain it in your possession. So the question is, what do you do with that $18,000 to $22,000? Well, the answer is simple. You strategically deploy it. You use that tax-free capital combined with the cash flow from your first property as a down payment or renovation budget for another asset, maybe even a second short-term rental. And guess what? That second short-term rental, so long as you materially participate in the management of it, can also qualify for bonus depreciation, generating more paper losses that can offset more of your W-2 income or be carried forward into future years. This is when your snowball begins and when you start playing the borrow until you die game. And this is what I want you to remember because these are the rules that the wealthy live by. Cash flow grows equity. Equity unlocks borrowing tax-free. Borrowed capital buys more assets. More assets like short-term rentals create more deductions, supercharged by bonus depreciation. More deductions eliminate taxes. Eliminated taxes mean more deployable capital. And more capital means acquiring even more assets. That, my friends, is the zero-tax snowball. It's the engine for the wealthy. And if you like this strategy and you want to see how it all comes together, then you're going to want to stay tuned for my next video that comes out because I'm going to show you exactly how and why wealth explodes when you own just one rental property. As soon as that video is out, you're going to be able to watch it right here. So I'll see you over there after, of course, you like and subscribe if you got value from this video. All right, see you over there.